project that we are looking at for future retail, and we have identified the after tax operating income for the company. And now basically we are trying to find out what is the return that they are generating on this particular project. So a basic calculation of return could be the return that they have generated on the capital that they have used. Now, what is the capital that they have used? Part of the capital that they've used is here, this entire portion. Part of the capital that they've used is here, and not necessarily here, but the remaining value of the assets that are there. So we have to find the current value or of investments that they carry, right, and assets that they carry essentially in the context of the project that we are looking at. So broadly, that's the idea that we are looking at, and we're going to compare the profitability that the company has versus the value of the assets and investments, right? So when we calculate return on capital, we're going to look at the final profit and we're going to divide it by the book value of assets plus the book value of working capital. Remember, working capital is also an investment into the business. So combine these two are going to give us the overall value of the assets that are deployed in a particular project, right? So that's what we are looking at. The recent book value of the initial investment of 500 crore being written down at a 10% depreciation straight line every year. So that's the value in each of the years, starting year 0, 1, 2, 3, 4, and so on and so forth till the 10th year, right? The remaining book value of assets that you have is the second line which we had, which is this one. Remaining book value of assets, that's coming from here, 300, 520, 598, etc. So that's 300, 520, 598, etc. And value of the working capital, remember we had said working capital is 10% of revenues at all points of time. So whatever the revenue is, 10% of that gives the working capital. A plus B plus C gives me the total book value. So that's A plus B plus C, assuming this is A, this is B, and this is C. That gives us the total book value. Now we already have the post-tax operating income as well. And when we put this, if we divide, so let's call this D and let's call this E. When we divide E by D, that's effectively my return on capital. So what I'm doing is E by D. That's my return on capital annually, right? Now, so the first few years, obviously this will be negative, and the third year onwards, it starts turning positive and then continues to stay positive and keeps increasing till the end, right? Obviously, because the same assets are generating a bigger revenue and a bigger profitability as we go along. If we take the average, and this is, remember, the arithmetic average, we can discuss at some point whether that's correct to do or not, but let's simply take the arithmetic average to begin with. That's 4.7%. So on average, in a given year, we're going to generate a return of 4.7%. So now we have this 4.7%, that is the return that we have calculated on average, and now we need to compare this to the money that we have put into the business, right? So what is the number that we should compare this to effectively? How do I know whether 4.7% is good or bad or not good or not bad, right? So this number needs to be compared to the cost of capital for the business of retail, essentially. That's the rate at which I will raise money, and this is my average return that I am getting year on year on this particular project if I use accounting earnings to kind of evaluate the entire thing, correct? Now, how do I calculate what is the cost of capital, right? That we've already seen. We're going to find out what is the weighted average cost of capital. So the average return is against 4.7%. How do we compare this? What do we compare it against? Since we have calculated return on capital, we need to compare this to the cost of capital of the future group, right? So let's calculate given the following data. Let's assume you have the risk-free rate at 5, beta at 1.2, equity risk premium at 8%, cost of debt at 10%, debt to capital ratio at 50%. Assume the standard transactions of 30% tax rate and all, right? So 5% plus 1.2 into 8% is going to be my cost of equity. Multiply this debt to capital ratio by 50% because equity to capital will be the other 50% plus 50%, which is my debt to capital ratio, into cost of debt. What is cost of debt? 10%. and I get 1 minus 30% on that because the tax break is available, right? That is what will give us the weighted average cost of capital that will come out of this, and that works at 10